Now, how does the deficit sort of play into this, if at all?
Well, I remember reading books in the mid 1980s and reading papers, and I was just in high school, but people were whining about debts and deficits back then. Here we are 40 years later, and now we're wondering whether, after decades of whining, does it actually matter? And as I said before, when you're in a bear market, which I think we're in when it comes to sovereign bonds, and I specify sovereign bonds, warts become more aware to people. Frailties and fragilities become more aware. And I do think that the debts and deficits that need to be financed on a daily basis now all of a sudden matter. And look at where we've seen a lot of the rate spike in terms of interest rates. We've seen it in the UK. And it happened within days of Rachel Reeves, the Chancellor of the Exchequer, announcing their new budget with the new Starmer government.
I'm always excited to do these live shows with my friend Will Ryan, but I'm especially excited today because the guest for the rough hour is Mr. Peter Boockvar. And there's going to be a lot of things we're going to be touching on as far as the macro environment, as far as what's going on with the bond market in particular. My name is Michael Gaia. This is the High Conviction Podcast by Granite Shares. Special guest is Mr. Peter Boockvar. And of course, my friend and co-host is Mr. Will Ryan. Will.
Thank you. And thank you, Peter, for joining us today. My name is Will Ryan. I am the founder and CEO of Granite Shares. We are a ETF issuer based in New York City, run a global business with products listed in Europe and presence in Asia as well. We manage around 10 billion and focus on what we call high conviction ETFs.
And of course, Mr. Peter Boockvar, who has some high conviction himself. Peter, I know a lot of people see you on CNBC, but introduce yourself for those who are not familiar with you.
Sure. I'm the Chief Investment Officer with Quickly Financial Group, which is a wealth management firm with about $12 billion of assets under management, but also doing like full wealth planning. And I write daily on the macro via Substack titled The Book Report, and just what I find relevant on the macro, on markets, and throw in a couple of our investment ideas of ours every once in a while.
Is there anything more relevant now than what's going on with bond yields?
I don't think so. I think when you sort of rewind the clock a bit, when in December 2020, we had $18 trillion of negative yielding securities, where geniusly central banks, and obviously I say that with a lot of sarcasm, turned an asset, that being a bond that gave you interest income, into a liability where it actually cost you money to hold. It was the bubbles of all financial bubbles, that being in sovereign bonds. And then, of course, that bubble met inflation and an aggressive rate hiking cycle around the world in 2022. And boom, there goes the bubble. But I do think we're in a multi-year bond bear market. And when you're in a bear market, it helps to expose frailties in markets. And, for 40 years in the bond bull market, debts and deficits didn't matter. Didn't matter what your debt to GDP ratio was. It didn't matter what your budget deficit was relative to GDP. But in this kind of environment where governments need more and more investors to buy their paper, these concerns all of a sudden matter. Then, of course, you throw in central banks that obviously have cut interest rates over the past year, which is then raising concerns about inflation flaring up again. Now that is occurred, now they're not going to be maybe cutting as much as the markets had anticipated. So I think it's sort of an all of the above situation, but the net result being higher interest rates. And that hasn't mattered much for stocks over the past year. And I think a lot of that had to do with the belief that central bank rate cuts in the short end were somehow going to relieve us of of all this interest rate pain across the yield curve. But in the beginning days of 2025, the latter part of 2024, we realized that those rate cuts may in fact have made the situation worse because longer term interest rates are rising in response, and that we're not going to get that central bank rate relief that so many people were hoping for, particularly if you were in the commercial real estate industry. So now here we sit with market multiples very elevated and interest rates that are staying stubbornly high.
You said something that was potentially concerning, which was that we were in a multi-year bond bear market. And I think for a lot of people, as you probably are aware, that when the Fed started cutting interest rates, I think people thought that potentially this was the start of another bull market for bonds. And obviously how different the situation is now with, at least the 10-year almost back to the peak that we saw kind of in 2023. So very sort of different scenario here. But are you sort of more persuaded by within that the argument that inflation is going to be sticky, and is this got something potentially to do with the tariffs? How do you think that this plays out, sort of multi-year scenario?
So I think it's a combination of the factors I mentioned and what you said. I mean, inflation has clearly decelerated, and in the U.S., I expect it to further decelerate, at least in the first half of this year, particularly on the services side, as slower rental growth works its way through the BLS data. But the question though is, there's one thing to have a spike in inflation and then the fall, but there's another thing in keeping inflation low. There's this assumption that inflation is just going to magically stop it and flatline at 2%. And maybe so, but I think that was more of a pre-COVID thing. And that inflation is going to more settle out after this decline, which, maybe it declines into the low twos, even the high ones. But I think 3 to 4% is going to be, at least for the next couple of years after this, as I said, deceleration, is something that markets, I think, will have to get used to. That's obviously well below the 9% that we saw in the summer of 2022, but that's much different than the 1 to 2% that we had and we were all hoping for this time around. Because 3 to 4 instead of 1 to 2 is a big difference in inflation, especially when you compound that. And also it means a lot for interest rates and keeping them elevated for a while longer. And it also sort of shackles central bankers from being able to fully respond to anything that comes our way negatively, particularly if growth rolls over to the downside.
How does the deficit sort of play into this, if at all?
Well, I remember reading books in the mid 1980s and reading papers, and I was just in high school, but people were whining about debts and deficits back then. Here we are 40 years later, and now we're wondering whether, after decades of whining, does it actually matter? And as I said before, when you're in a bear market, which I think we're in when it comes to sovereign bonds, and I specify sovereign bonds, warts become more aware to people. Frailties and fragilities become more aware. And I do think that the debts and deficits that need to be financed on a daily basis now all of a sudden matter. And look at where we've seen a lot of the rate spike in terms of interest rates. We've seen it in the UK. And it happened within days of Rachel Reeves, the Chancellor of the Exchequer, announcing their new budget with the new Starmer government. We've seen it in France with worries about their government and their budget deficit being in a range of around 5.5%. Obviously, I think we're seeing in the U.S. with a 6% plus budget deficit, where I think that this all of a sudden matters. We've seen it in Brazil. We've seen both the currency market and the bond market call out the excessive spending that we're seeing out of the Lula government. Now, also, I think what is a major factor here, and I need to emphasize major in terms of global bond markets, is what we're seeing in Japan. I attribute the move in the summer of 2024 in the 10-year yield from 360 that eventually went to 5. That move began, I believe, coinciding with the Bank of Japan essentially ending yield curve control. So fast forward now, we have the BOJ possibly raising interest rates this month, and which began in 2024 and is going to carry through to the first quarter of 2026. The BOJ is slowing the pace of their asset purchases by about 400 billion yen per quarter. And the net result of that by the first quarter of next year is going to be basically a halving of their QE. To me, the BOJ was the architect of modern day QE and of zero interest rates. And they obviously went negative following the Europeans. And their foot was on the neck of interest rates for many decades. And that foot is slowly coming off. And I think that also has a global and liquidity influence in driving where global interest rates are going.
And at the moment you mentioned Japan, Michael's desperate to ask you a question. But
yeah, no. It's interesting because I've been very appalled about the reverse carry trade, obviously. But I want to go back to the inflation point for a bit because it seems to me that there's going to be a sort of a self-solving mechanism here. If part of the inflation stickiness is because of asset prices, so the wealth effect, it seems like the easiest way to resolve all of this to get cuts back on the table is for the S&P 500 to have a run-of-the-mill correction or even maybe a bear market, another somewhere between 10, 20%. Would that not get us to where the Fed ultimately wants us to be with inflation? You just need to have equities be the driver of it on the downside?
Well, an equity decline certainly would be a negative for the economy. When I look at the U.S. economy, I see just three areas of strength: higher income spending, anything related to AI spend, and anything directly or indirectly related to government spending. If you knock off double-digit percentage returns out of the S&P, well, you're certainly going to negatively influence, that first factor, that being the higher income consumer and spender, because we know the lower income consumer is essentially in their own personal recession because of the cumulative rise of nearly 30% in inflation. So yeah, maybe that does knock the economy. That eventually gets interest rates to fall. But is it going to be a further rise in interest rates with the 10-year yield at 5% plus? That is the factor that eventually gets the stock market to fall, inflation to fall, and rates to fall. So it's almost like a pick your poison type situation, it seems.
Yeah, because certainly just to talk about mortgages for a second, one of the arguments clearly around cutting rates and starting on this easing cycle was that financial conditions had gotten too tight and mortgage rates had climbed to the highest they've been for some time. But actually now looking just the other day, the 30-year mortgage is back to a level higher than it was even a year ago when mortgage rates kind of peaked. So this is very concerning for people who are clearly in the mortgage market or looking to finance, whether it be for homes, auto loans, etc. And really makes it much harder to think about how we get out of this, bar some kind of correction.
Yeah, we basically had 2 months of relief last year when long rates that fell going into the September rate cut. But that was it. There was, again, this belief that the Fed was going to save the day with rate cuts. And we've seen the exact opposite. We basically had the long end of the bond market telling the Fed, you did the wrong thing by cutting 100 basis points. You did the wrong thing by starting this off with a 50 basis point cut. And you're doing the wrong thing by still being so dovish. Like I said earlier, there's one thing to have inflation fall back down, but there's another thing in keeping it down. And in a lot of speeches last year, we heard from Fed members that talked about the need for a sustainable fall in inflation. And what the Fed did not do was wait for the sustainability of the decline. I like to say that they tried to catch a falling inflation knife. And at least right now, it has cut them.
Well, I keep going back to the analogy of it's the old George Bush mission accomplished, right? I mean, that's really
not right. No, maybe they end up being right. Maybe inflation ends up staying down. But that's not the point here. The point is waiting to see whether that happens. And they quickly shifted their focus because the unemployment rate ticked up, and a few other labor market data points ticked up, and they tried to get cute here. And like I said, they tried to catch this falling inflation knife, thinking that the decline of inflation was the victory. But the decline is just one battle. Winning the war is keeping it down. And that remains to be seen whether they're capable of doing that.
So what's the worst move here for the Fed to start raising interest rates again?
No, I think what we've seen is the Fed walking back the need for more. I mean, right now, as we speak, we're pricing in just one more cut this year, and that's not until fully priced until October. The odds of a second are down to like 8%. Last year, the summer of last year, going into that September cut, we were pricing in, I think it was a 280 Fed funds rate. Now the Fed funds rate is ending this year at around a little above 4. So we took out 120 basis points of cuts. So from that perspective, the Fed's done what they needed to do. But there's a real problem here on the flip side of that, because on the other hand, talked about debts and deficits being a worry of the market. Well, higher interest expense is now one of the key drivers of the rise in debts and deficits, where it sort of compounds on itself. And higher interest rates are going to keep interest expense further elevated and drive it even higher. I think there's about $400 billion of notes coming due this year just on a refinancing, with the balance being more T-bills that have already sort of experienced the rise in rates. So $400 billion with all maybe 200 basis points higher interest expense relative to where it was on the maturing debt. So that's another $80 billion of interest expense. And then you throw in an extra $2 trillion of a budget deficit that needs to get newly financed at current interest rates. So there is a rock and a hard place situation here that the Fed and the market has placed them and the U.S. government in, this bind.
So are we sort of looking at a year that maybe looks a little bit more like 2022 at this point? Or
please don't say that. Please don't.
Well, 2022, we had the very fast rise in interest rates.
Yeah.
I don't think that rate of increase is going to be repeated. Certainly not going to be repeated on the short end with the Fed funds rate staying where it is. The long end, though, is what's causing the frustration, because the other thing that I haven't mentioned yet is there's about $850 billion of investment grade debt that is coming due this year that needs to be refinanced. Now, some of it was done in December, January, and some others have already refinanced this, but there is a big maturity wall this year, 2026, and also 2027. Now, I'm not worried about the credit qualities of these investment grade names, but they could see their interest expense go up, and by similar to the U.S. government by maybe 200-ish basis points. One thing we have to keep in mind is that for the last 15 years, one of the major drivers of profit margin expansion was lower interest expense. When rates were very low, obviously the Fed funds rate was at 0, and corporate America was able to refinance at very low rates. So that sort of below the EBITDA line was, as I said, one of the main drivers of profit margin expansion at the net income line. Also, the corporate income tax rate helped, and above the EBITDA line, lower labor costs also helped out too. So now, if all of a sudden you see a lift in interest expense with peak profit margins, that's something that I think we need to digest as well when it comes to our earnings estimates for this year and next year.
If you could put percentages around it, what would you say is the biggest driver of the yield rise? Is it the Fed? Is it tariff expectations? I happen to think this most recent move may be driven more by Japan, because I do think they're going to have to intervene this month on the yen, especially as oil spiking, which we should touch on, kind of the oil movement here. But how much of it is monetary versus the expectations on the fiscal side?
I don't know how to slice and dice it percentage wise. I like to say it's just all of the above. I think one of the other tells here is, in the face of rising nominal and real rates, that the price of gold continues to trade as much as it does, and the dollar rallying. So the dollar's rallying against all these currencies, but it's falling against the price of gold, which tells me that the debts and deficits matter now more than they ever have.
Globally, on top of that, to your point, it's in every currency, right? So it's
Yeah. So, I mean, that gold is going up in the face of this extraordinary dollar rally against all these other fiat currencies tells me that there's this still very big bid for gold that is able to overcome the dollar strength against other fiat currencies. And I think it's just foreigners that are just saying, I am going to more highly scrutinize buying U.S. treasuries. And if I'm not going to buy them, or I'm just going to buy less of them, gold is a pretty good alternative.
Yep. And also to boot, any other sovereign bonds for countries that have, pretty high debt levels.
Yeah, there was a rethink on sovereign bond allocations across the world, and certainly at the central bank level. Now, central banks still need to own a variety of different currencies and reserves and denominated in all these, but they can still own them just by owning short-term gilts or short-term JGBs or short-term French oats. They don't need to take the duration risk.
Do you think that we see a repeat of that August 3rd, August 5th reverse carry trade? I mean, not that I'm hoping for, but I just think the odds are much higher than people think. And nobody seems to think it's possible, again, which is probably why it matters. Any thoughts on that sort of scare repeating itself?
Well, I think we could have another scare, but I'm not sure what the trigger is. Like, I don't know. Well, I thought that that carry trade was very big last year going into that August sort of market earthquake. I never was fully aware of how big it was. Only until the unwind did you get a sense of who's swimming naked. This time around, I don't know what is left of it. I don't know what was put on again when the yen started to weaken. I'm not sure. I think what would be a similar shock is similar to what you had in the gilt market last year with the liability-driven investment yield spike, where the Bank of England had to get back involved and buy gilts. If the 10-year yield starts to spike to 5.5%, you'll have the same, leveraged unwind of a variety of different things. And whether it's a yen carry trade or it's a US dollar carry trade that needs to be unwound, or some other leverage carry trade, it could be that as well.
What do you think this does, I guess, for the equity market, this year?
Well, I think there's little chance we have another 20% rally like we did in 23, 24. I think a large part of that rally was multiple expansion. Yes, we did have some earnings growth after an earnings recession that we saw, but I think last year earnings growth was up 7% and the S&P was up 23. Well, again, that's all multiple expansion, or predominantly multiple expansion. And a lot of that, I think, had to do with the belief, and as we spoke about earlier, was, the Fed's going to cut interest rates, and what do you get? You got to buy stocks, right? Fed's cutting, you got to own stocks. That's what we were all conditioned on. But now we're again waking up to the reality that, and sort of mugged by the reality that central bank rate cuts have not helped, and you can argue it made it worse. And they may not cut that much more anymore. So do I still want to pay 22 times 2025 earnings estimates for the S&P? And that multiple even assumes 15% earnings growth, an acceleration of earnings growth. What happens if that doesn't happen? Maybe it does, maybe it doesn't. But I do think that this year is going to need that earnings growth to offset the potential for a PE multiple fallback. Now, keep in mind, when you're estimating $270 per share in earnings, every multiple turn is 270 points in the S&P. So all you need to do is go from 22 times to 20 times, and that's 540 points in the S&P that you've just taken away without any change in the earnings side. And I think that's one of the hardest things to do as an investor is, all the sell side that tries to predict where the S&P is going to go. Usually they're somewhat right when it comes to the earnings side, but it's getting that PE multiple side right that's always very difficult. And going into 2024, I didn't know of anybody that predicted that level of multiple expansion. Now it's, the sell side typically, as they do, is whenever the multiple ends the year, they just assume it stays there in the year that follows. So they're now assuming, even with this rise in rates, that the PE multiple is just going to stay the same. And I question whether that's possible if the long end continues to sort of revolt here and possibly goes even higher. And what we saw in December, outside of the biggest names, there was a big market pullback in the Russell on the reality that the Fed's almost done raising and long rates have risen. I think on concerns about what this rate move means for multiples and possibly the economy, as I talked about, particularly on the earnings side with higher interest expense, with the maturity wall that's going to mostly hit investment grade this year.
Yeah, the Russell doesn't seem to be able to catch a break, doesn't it? Every time that the small caps are back, they get slightly smacked down by higher interest rate expectation. I think it was about a third of the Russell, isn't it? They're unprofitable companies,
zombie companies, right? It's like death by 1,000 cuts. To your point about momentum, if anybody tries to do a momentum signal on small caps, is just paper cut. It's just you're not getting any persistence. And to your point, Peter, it's like you have these fleeting moments where it looks like it's going to run, and then gives it all back. Right? So it is a remarkable thing. And also, you can correct me if I'm wrong there. It's not like small caps are necessarily cheaper than large caps.
Well, they're cheaper than the largest of the large caps, but not necessarily the 490 large caps. You're right. On 2023 and 24, or most of 24, was a help to the small caps because a lot of them are also SOFR plus base borrowers. Well, if the Fed's going to cut Fed funds rate and SOFR rates fall, well, that can lend some relief to their financing. But now that the Fed is not taking the Fed funds rate down to 2 3/4 as we were pricing last year, and maybe they only stop at 4, well, we're not going to get the SOFR relief that a lot of small businesses were hoping for. And then, of course, we still need a healthy economy, and we wonder whether we can have one with the economy, as I mentioned, really sitting on only 3 pillars and not others. Manufacturing in a recession. Capital spending ex AI has flatlined. If you look at the non-defense capital goods ex aircraft data, pace of existing home sales at 30-year lows, and a lot of ancillary activities that don't take place upon a turnover of a home. So the U.S. economy is not firing on all cylinders. It's firing on a few. And I think we have to keep in mind that it's a more mixed and uneven economy than what a 2.5% headline figure makes it out to seem. So at best, as I said, corporate income tax rate stays the same. On the individual side, at best, we're hoping they just get extended. They're not falling further, they're just getting extended. And then on the positive side, we are going to get the regulatory relief that we're hoping for. No doubt under the Biden administration, they had their foot on the neck regulatory wise on business. That's going to get pulled up. But on the other hand, what are we going to have to experience on the tariff side? We have to remember the 2017, 2018 tariffs put U.S. manufacturing into a recession, quickly ended the Powell rate increases, and then he actually started cutting interest rates in response to those tariff increases. So there's no free lunch here when it comes to the tariffs. And there's a growing belief that in order to extend expiring tax cuts, they're going to have to increase the tariffs in order to pay for that extension. So there are a lot of pushes and pulls here. And I think some of that reality now has begun to sink in.
And with on the other side, let's call it the Doge sort of project that's been talked about. I mean, clearly cutting government employees and cutting the size of government more broadly could be seen as disinflationary, maybe deflationary. Is that an offsetting force to all this, or do you think that will not be as successful, perhaps, as maybe thought initially?
I mean, I think longer term, if they do cut the size of the government and they can make it somehow more efficient, which is somewhat of an oxymoron, but we can all hope that they do, that's hugely bullish over time. But to your point, in the short term, if there's wholesale firing at the federal level, that's a negative for the economy. Now, the hope, of course, is that these public sector workers can find jobs in the private sector. Hopefully that's the case. I mean, we saw in the November JOLTS data, there's still 8 million job openings out there. Now, some of that is redundant and not necessarily real, but that's the hope, is that the government can become more efficient in terms of productivity per person, and some of these people can work in the private sector instead, where they'd be a lot more productive for sure.
What do you think is the most expensive part of the investable landscape, and then conversely, the least expensive or cheapest? Right? I mean, you always hear about the everything bubble, but there's degrees within that.
Sure. Well, if you look at the biggest names in the S&P, the names we all know, the Googles, Apple trading at 33 times earnings is a ridiculously overvalued stock. It's not an opinion on the company itself. And
Zuckerberg would agree, by the way, given some of his attacks on Apple.
It's not it's all on the beauty of their business, but for a company that has no growth, that's and trading at 10 times sales, that's an egregiously overvalued company. Microsoft trading in 30 multiple, and a brilliant company, but a mid-teens earnings growth rate. Yeah, that's pretty rich. Tesla, great company, I believe, and we can all praise Musk, even though we can all criticize at least the auto side of the business also at the same time. But from a multiple standpoint, that's egregiously overvalued. Yes, there's a lot of hopes and wishes in some of his other businesses, but it's pretty overvalued. So to name a few, and even Amazon, the AWS business being a high margin, highly valued company, the retail side of their business, very low margin, hugely competitive industry. They're great in it. They have a tremendous presence, but even Walmart at 30 times earnings is very overvalued. These are all phenomenal companies. I just think that they pulled forward a lot of hopes and wishes in terms of earnings growth, and just like we saw in the 2000s, that there could be just a sort of a timeout on these stocks as they sort of grow into their multiple. Just how Cisco has been trying to grow into the year 2000 multiples and has been doing so for 25 years. And their earnings today, their revenue today is much greater than it was then, but their stock is below where it was then because it pulled forward 25 years plus of top and bottom line growth.
That's right.
What happens again? I'm just saying, to Michael's question of where some of the overvalued parts, when you're talking about Microsoft, NVIDIA, and Apple with a market cap of $10 trillion, that's about 10% of global GDP. Those are big numbers. And yeah, they can get bigger. And I was surprised they even got this big. But you can argue, as I just did, that these are more of the expensive parts of the market in this so-called, everything bubble. I can also throw in where, prices of art have gone, and the banana taped to a wall that went for $6 million is part of this overvalued discussion. I collect baseball cards. There are certain areas of that market that have gotten ridiculously overvalued. But then on the other hand, there are things that have been left for dead. There are value parts of the market that have been left for dead. You can buy 10 PE multiple stocks where I think there's that certain businesses are not going under. And there's plenty of value in international markets.
So that's a good point, because people always bring up that. And I think in some respects, there's a little bit of a joke, but people have been talking about Europe being a value play now for as long as I can remember. And it never really escapes that tagline because ultimately you're missing the growth that you see in other sectors, other parts of the market. Is there a bull case at all for Europe?
There's a bull case for certain European stocks for sure, because there are companies in Europe that are big multinationals, just as there are in the U.S. But because of where they're domiciled, they get multiple hits to them relative to their U.S. peers. There are companies in Europe that have big exposure to Asia, where I think over the next 10 years, Asia is going to have the fastest growth in the world. But again, because of where they're domiciled, they get punished, and that won't change until it does. Will it change? I don't know. I think it will. We own some cheap European stocks with great businesses that are just, like I said, just cheap because where they're based rather than cheap because of the state of their business. So will that change at some point? I think it will. Now, the weaker euro is certainly not helping sentiment when it comes to Europe. So you need some stabilization and maybe a lift in the euro to help sentiment towards European stocks. But European stocks actually, the last couple of years, have rebounded. But and even Germany last year, because of some of their multinationals, was up, I think, 15-16% last year in the face of an economy that probably contracted. So there are definitely opportunities in Europe, but you got to have patience. And that's the thing about the markets over the last 15 plus years is the U.S. big cap tech industry has sucked all the equity oxygen out of the global room. And but that's why multiples are where they are, and that's why U.S. market cap relative to global market cap is, I think, north of 60%, 65%. And I don't know if it's ever been that high. So this U.S. centric belief is certainly well entrenched. And, you need a sort of a change in that psychology to shift things. Will that change come from a slowdown in earnings growth in the hyperscalers? The questioning of all this AI spend, a slowdown in the rate of NVIDIA's growth at some point? Maybe. I think that'll all shift investor focus to other things. I mean, we started to see that in July of last year, where investors finally figured out that there were 493 other stocks out there in the S&P. There were 2,000 other stocks there in the Russell and more in the mid cap, and there were other stocks outside the U.S. Now, that lasted only a few months, but it gave me hope that investors do have enough imagination to understand that there are more than just 7 stocks out there.
I was on a podcast, and I have not verified this, but the guest said the stat was, had you taken out NVIDIA as a contributor to the S&P's performance, the S&P and European markets pretty much behaved the same performance-wise. It was just that one. I haven't verified that, but it sounds kind of right when we look at the outsized contribution. Any thought to sort of allocating on a go-forward basis here? I know you're much more focused on the value side, obviously. Doesn't sound to me like you have maybe much tech or kind of advocate for it. But then again, it's one of those things where if tech momentum continues, you kind of need some exposure to it because end clients are not going to be as thoughtful as you or anybody in general that's trying to manage risk. Or very patient, exactly, right. So how do you think through sort of allocating here?
So we do have the obligatory exposure, which it's not meant to be derogatory. It's been very successful over the past 15 years plus, is to own the market and own these big stocks and have no choice but to have exposure, which has helped. But also we have the ability to not just only be exposed to that. We have the ability to look at other things. Now, investors do get frustrated with us when, okay, how come you're not 100% in these top 10 stocks? How come you're not only on the S&P? Well, we have to go over, moments in history where, the pendulum swung in the other direction. And we're not necessarily smart enough to know of when that swing takes place. But, we still want to, have exposure in a variety of different things. Now, if there was ever going to be a trigger for that pendulum swing, I do think it's this persistent rise in rates and an eventual rethink in PE multiples. When a stock is trading at 12 times earnings and it has some decent growth, it's just not being rewarded because maybe that growth is not as robust as a growthy name. Well, it already has inherently low expectations in it. So when you think about a 30 PE multiple stock going to 20, well, that's a 33% decline in the stock. A 12 multiple stock, that goes to 11 or 10. Well, that decline in the equity may not be as much, and maybe 12 stays 12. It's already been beaten down already, and expectations are already low, so maybe it doesn't fall that much more. So I think that's what people need to think about is when everyone is betting, okay, the Fed's going to save us, rates are going to fall across the yield curve. you can extend out this valuation agnostic approach to investing. But when that all of a sudden changes and you need to be more sensitive to the multiple you pay for something, 50 multiple, 40 multiple can quickly become 40 or 30 or 20. Your prospects for the company may be fine still. But because on the way up, if I'm paying 30 times, why not just pay 40 times? And markets get carried away and they pay 50 times. I mean, Costco's trading at 50 times earnings. I love Costco. My wife loves Costco. Everyone loves Costco. But when you're trading at, I think, 50 or 49 times earnings, that's pulling forward a lot of earnings expectations. And 50 multiple going to 40, is a stock hit. There'll be no change in the amount of people that shop at Costco, but that won't stop the stock from falling if it goes from 50 times to 40 times.
Maybe almost like kind of finish off where we started. Clearly the biggest issue for the markets today is the rising interest rates. Is there anything, the Fed, or what levers can the Fed pull here?
It's very difficult for them to pull levers unless inflation stays down. And when I say stays down, I don't know what time frame I'm talking here, but I know it's more than just a quarter or two. You need inflation to get to 2 or less and stay down there. That would give the Fed some breathing room. That would maybe give the long end some breathing room. Maybe Doge has more of an impact than we think and slows the rate of government spending, because there'll never be such thing as a declining government spending. We're talking about slowing the rate of government spending, of those increases. And those are the things that we need to see. But that's not an event. That is a multi-year process that is going to play out here. This is a different playbook than what we saw during the 40 years of a bond bull market, where central banks had license to do whatever they wanted, whenever they wanted. Now it's a different ball game, and we have to adjust to it and look for the things that may hurt us, but also look for the things that may sort of ease some of the pain. But there's not the same level of flexibility that the Fed and other central banks have had in the past. I can promise you.
That brings up another kind of interesting topic, which is, are we potentially now entering a scenario where the Fed, for the first time in probably as long as we can remember, is less relevant than it ever has been? In other words, because of the circumstances we now find ourselves in, that the role of the central bank no longer can be that sort of license to do anything and be that outsourced, force in markets.
Well, they are potentially less relevant because they were made so in terms of their ability to influence the environment around them. And that debts and deficits will drive the long end of the yield curve, for example, more so than where the Fed takes the short end. That the ability of the Fed to sort of manipulate the inflation rate, maybe it's less influential. I mean, look what we've seen with home prices. The Fed cut 100 basis points and long end rates have gone down. And that's on top of a 50% increase in the price of the value of homes since COVID started. So rates have gone up as the Fed cut. So they're being handcuffed by both the economic reality and the fiscal reality of the world that they now live in.
We always like to wrap up these conversations by asking, since this is the High Conviction podcast, what is your highest conviction, Peter?
So I'm going to give two. One are the gold mining stocks that have dramatically lagged the price of the metal. And my new love that we own are the fertilizer stocks that have been browbeaten down to a pulp. But all of a sudden, as we tape this, the price of corn is at the highest level since December 2023. And there is a high correlation between corn, soybean, and wheat prices and fertilizer prices. Now, soybean prices are still depressed. Wheat are depressed. Other parts of ag, we've seen record highs in coffee and cocoa and cattle. But now corn prices are getting a bid. So I really like the fertilizer stocks.
Good stuff.
It might be an interesting idea for Granite shares to go into, Will, at some point. Anything else that we should think through, Peter? I mean, for those who want to track more your thoughts while you're working, everyone loves to see on CNBC, but any other places people can find you?
No, just my daily Substack and commenting on a bunch of different things. And on the wealth management side, they can check out our website. And as you said, out there in other facets, giving my 2 cents.
And Peter's a very good fisherman, by the way. I know that from the Camp Kotak get together that we had, which we're going to do again, I think. You're going to be the next one?
Yes, I will. There's nothing more skillful than just sitting there with the rod that a guide has prepped you with.
That's exactly right. Hopefully we can get Will on that too at some point. So, Will, all you to wrap up here.
Yeah, no, Peter, thank you so much. Great conversation. And thank you to everybody for listening. Once again, this is the High Conviction Podcast. We'll talk to you soon.
Thank you, guys.
Cheers, everybody.
Thank you.